Hey everyone, welcome to The Explainer. Today we're unpacking the ultimate playbook for claiming the Georgia Path to College 529 tax deduction. If you live in Georgia, I'm telling you, this is absolutely one of the most powerful financial tools you have to save for education and slash your tax bill at the exact same time.
I mean, think about it. Do you want to lower your Georgia state taxes just by saving for a student's future? It sounds like a total win-win, right? And honestly, it really is, but only if you know exactly how to navigate the rules of the game.
So here's our game plan for today. We'll quickly cover the Georgia 529 Advantage, look at eligibility and limits, walk through a step-by-step filing guide, point out some common mistakes you definitely want to avoid, and finish up with strategies to maximize your benefits. Let's jump right in.
Section 1. The Georgia 529 Advantage. Let's start with the absolute basics.
The Path to College plan offers what I like to call a brilliant triple threat of benefits. First off, your money grows tax-deferred over time. Second, your withdrawals are completely tax-free as long as they're used for qualified education expenses. And third, which is really the star of the show today, Georgia taxpayers get an exclusive state income tax deduction literally just for putting money into the account. Section 2. Eligibility and contribution limits. It's time to know your numbers. So here's the deal. Your filing status totally dictates your limit. You can deduct up to $4,000 per beneficiary if you file as single or married filing separately. But if you're married filing jointly, that jumps to $8,000 per beneficiary. And notice that phrase, per beneficiary. That's huge. Say you're married filing jointly and saving for twins. You could potentially deduct up to $16,000 from your Georgia taxable income in a single year. That is a total game changer.
To put that generosity into perspective, Georgia offers a specific dollar limit. This is completely different from a state like Florida, which has no state income tax, so obviously no deduction exists there at all. Or take Colorado, which actually offers an unlimited tax deduction. It's really fascinating how this varies state by state, but Georgia sits right in this sweet spot, offering a very generous, capped benefit.
Moving on to Section 3, our step-by-step filing guide, let's make sure your tax paperwork is bulletproof.
Now pay close attention to this one because it's a massive recent change. The simplified Form 500 EZ, it is permanently discontinued for tax years starting on or after January 1, 2025. That means every single person, no matter how simple your taxes might be, has to use the standard Form 500 to claim this deduction. Do not let an outdated form hold up your refund.
All right, here is your exact play-by-play for filing. Step 1. Calculate your federal adjusted gross income. That serves as your starting point. Step 2. Jump over to that mandatory Georgia Form 500 we just talked about. And Step 3. Report your 529 subtraction on Schedule 1. If you're using tax software, you'll usually spot this in the state subtractions or adjustments menu, but definitely keep your eyes peeled for that specific Schedule 1 designation. And here's a massive sigh of relief for a lot of you. This is considered an adjustment to income. What does that actually mean? It means you absolutely do not need to itemize your deductions to get this benefit. Even if you just take the standard deduction on your federal and state returns, you can still subtract those 529 contributions and lower your overall state tax bill. It's incredibly straightforward.
Section 4. Common mistakes to avoid. Let's protect your savings and highlight some costly filing errors.
You want to avoid critical, unforced errors. Obviously, don't use that old easy form, but also be super careful not to claim deductions on incoming rollovers from other out-of-state 529 plans. Georgia strictly prohibits that. Only brand new contributions qualify. And finally, whatever you do, avoid making non-qualified withdrawals.
Because if you do make a non-qualified withdrawal, ouch, you're going to get hit with a steep 10% federal penalty tax on your earnings. And it doesn't even stop there. You'll also owe federal and state income taxes on those earnings, and Georgia is going to require a recapture of your previous deductions. It's just a massive compounding financial headache that you want to avoid entirely.
To steer clear of those penalties, just make sure your withdrawals strictly cover qualified education expenses. The great news here is that this definition has really expanded wonderfully in recent years. It's not just traditional college tuition and dorms anymore. It now includes K-12 tuition up to specific limits, registered apprenticeships, and, get this, even up to a $10,000 lifetime limit for paying down student loans. Pretty awesome, right?
Section 5. Strategies to maximize benefits. Once you have the basics down, let's look at how to take this to the next level.
Did you know you actually have until the federal IRA contribution deadline, which is usually April 15th of the following year, to make a contribution and apply it to your previous year's Georgia tax return? So if you're sitting there in March doing your taxes and realize you want to knock down your state liability, you can literally still fund your 529 before tax day and claim it for the year you are currently filing. It's practically financial time travel.
You can also compound those tax savings by opening accounts for multiple beneficiaries, which multiplies those $4,000 or $8,000 limits we talked about. Plus, you can take advantage of relatively new rules that allow unused 529 funds to be rolled directly into a Roth IRA for the beneficiary without penalties, assuming certain conditions are met. And finally, if you happen to have a lump sum, you can leverage the 5-year gift proration rule for some seriously efficient estate planning.
So to wrap up our playbook, hit those April 15th deadlines, know your exact filing status limits per beneficiary, always use the correct Form 500 and Schedule 1, and play strictly by the qualified withdrawal rules.
Now, a quick disclaimer here. As always, tax laws are incredibly specific to your personal situation, and they can change over time. So please consult a certified tax professional or financial advisor before making any major financial moves based on this explainer.
I'll leave you with this final thought. Instead of just handing that money over for state taxes, why not redirect those funds to build a loved one's educational legacy starting today? You have the tools, you know the forms, and you know the deadlines. Thanks so much for joining me for this explainer, and here's to making your money work a whole lot smarter for your family's future.